was a seismic shift in the stock market yesterday, and something pretty amazing happened. For the first time in 23 years, the small cap index outperformed the tech-heavy NASDAQ by the biggest margin. And at the same time, you can see that the stocks that have been leading the bull market this year, your AI-related stocks like Microsoft, Google, Amazon, NVDA, Meta, Apple, they were all down yesterday, and everything else was up, which were the financials, industrials, the real estate stocks. So why has this happened, and what does this mean for the stock market for the rest of the year, and what should you do about it? Let's find out in this video. So far, the majority of the gains in the S&P 500 has been led by just about 6 stocks. The AI-related stocks like your NVIDIA, your Apple, your Meta, your Microsoft, and so on and so forth. In fact, year-to-date, the S&P 500 is up something like about over 15%. If you take away these 5 stocks, the rest of the stocks are only up over 3%. So why has this happened so far? Because again, one of the main concerns is that interest rates are high and no one knew when the Fed would start cutting interest rates. Everyone thought they'll start cutting at the start of the year, but in the end, it got pushed back and no one knew when they were going to cut rates, right? Now, as long as interest rates remain high, money was flowing into these big mega tech stocks for 2 reasons. Number one, of course, they're making the most money because of their relationship to the AI revolution. But number 2, because these big tech companies are known to be immune to high interest rates because they've got very low debt, so high interest rates doesn't bother them. In fact, they've got so much cash that high interest rates means they earn a lot of interest income. So in a high interest rate environment, these mega cap stocks are known as the safe havens. Everyone wants to hide in the mega caps, right? And the other stocks, especially the small cap companies, small to medium sized companies, they usually have a lot more debt. So high interest rates hurt them a lot. And other sectors like real estate, industrials, financials, high interest rates are not too good for them. And so again, for the first part of the bull market, these guys were getting all the attention, all the love, and the rest of the stocks were getting no love, baby. But something happened differently yesterday. There was a rotation where what was once loved was no more loved, at least for one day, right? And those that were unloved are now loved again. So what happened to cause this seismic rotation? Well, a combination of things, right? But it all started with the Fed chair a few days ago. For the first time, he acknowledged that high rates could hurt the economy. Now remember that for the Federal Reserve, they've got 2 mandates. One is to kill inflation, to bring inflation down. Number 2 is to support the economy. And for the last 2 years, they were just focused on killing inflation. They say, we don't care about the economy. Economy can go into recession. Too bad, so sad. It's killing inflation. But for the first time, Jerome Powell acknowledged that now they are concerned about the economy as well, because inflation looks like it's under control. And he said that if we keep rates high too long, it's going to hurt the economy. So in other words, he was hinting that I'm going to cut rates soon. Okay, so that was the first thing that went on. And then yesterday, the market felt that the deal of interest rates being cut in September was sealed when inflation shockingly came in negative month over month for the first time since 2020, for the first time in almost 4 years. So you can see that the month-to-month growth for CPI for June, everyone expected a 0.1% increase, but we got a minus 0.1% decrease. So that was pretty amazing. But of course, on a year-on-year thing, CPI still grew, of course, 3%, but below the 3.1% estimate. So in other words, inflation looks like it is heading lower. So as a result, what happened? You can see that the probability of the Fed cutting rates in the September meeting shot up to 92.7%. So in other words, it's more or less a done deal. They're going to cut rates in September, probably in November again, and maybe even in December. So what do lower interest rates mean? It means that companies that were suffering as a result of the high rates for the last 2 years, now they should be doing a lot better. They should be rebounding. And that's why money started to flow into these rate-sensitive stocks. Example, real estate. Real estate doesn't do too well when rates are high. Now rates are coming down. Real estate roared back. So you can see, for example, yesterday, which was the one-day performance, boom, real estate gained 2.76%. What else does well? REITs. If you have been tracking REITs, real estate investment trusts, they had huge jump yesterday and today in the Singapore markets. Things like basic materials, utilities, industrials, and finance, they all benefit from lower interest rates. Of course, again, small to medium-sized companies measured by the Russell 2000 index will do better with lower interest rates, because these small to medium-sized companies, they don't have a lot of cash. They have a lot of debt. And so with high interest rates, they pay a lot of interest expenses that profitability suffers. But with lower rates, they become more profitable. And that's why investors started pouring into the Russell 2000 stocks yesterday, rotating out of the NASDAQ 100, which are the big cap tech stocks. So you can see this was yesterday's one-day IWM, which is the small to medium cap index, outperforming the S&P 500 and the NASDAQ by the biggest margin in 23 years. Now, of course, this is just one day. It's just one day, right? If you take a look at year to date, of course, year to date, you can see that the NASDAQ is still outperforming the S&P 500 and outperforming the small to medium size index. But look at the outperformance in that one day. This guy is kind of like, I'm coming back, baby. Give me some of that love. And they are giving up some of the tremendous love that they give, sharing the abundance with the small to medium sized guys. So then the question would be, okay, Adam, I understand that small to medium sized companies benefit. They're going up, industrials going up, real estate going up, but why did the tech stocks go down? What's wrong with the tech stocks? Are high interest rates bad for them? No, nothing wrong with them. These tech stocks, Amazon, Meta, Google, NVDA, they are still solidly profitable. They're still great companies. The only reason they came down yesterday is because investors who were invested in these companies, they had to take profit. They had to sell to raise the money to buy all these unloved companies. So it was kind of like a short-term rotation. You can see what happened on this bar chart. So again, just yesterday, investors took profit on the Magnificent Six stocks over here, which were concentrated in technology and communication services, your Amazon, NVIDIA, Google, Microsoft, and they use this money basically to rotate into these other stocks, driving real estate, utilities, basic materials, industrials a lot higher. But of course, that's just one day. On a year-to-date basis, your AI megatechs are still the leaders. No doubt about that. They are not giving up their leadership. I'm not saying they're giving up their leadership. They are still leaders year-to-date up there, up 29%, up 24%. The only thing is that for just yesterday and maybe a few more days, they will give up some of their gains in order for money to rotate and to share the love with these other guys. All right, so it's kind of like these guys are way ahead. These guys were far behind. So right now, some money is going out to these guys so that these guys can catch up. So overall, is this good for the bull market? Is this good for the stock market? The answer is yes, it is very good, because we call this the broadening of the bull market. But initially, the bull market was only being led by the Magnificent Six and these two sectors. But now, the rest of the sectors are joining the bull market. They're catching up so that all the sectors can participate in this broad bull market rally. And that's really good for the bull market, right? Now, the question some people would ask would be, so Adam, in order for the rest of these sectors to keep going up, does it mean that the technology, the mega caps, have to keep going down? Not necessarily. They can both go up together for the rest of the year. Then you may say, then where's the money coming from? Because you need money to go into buy these stocks for it all to go up. And the answer is, it's going to come from the money market funds. That's right. So, in case you don't already know, as of June this year, there's a crazy record 6.1 trillion of cash parked into money market funds. So, ever since the start of, you can see over here, especially 2022, right? The money market funds exploded. Well, a lot of investors basically park all their cash in these funds to get attractive interest rates. Now, what do you think is going to happen once the Fed cuts interest rates? Once interest rates come down, these money market funds will no longer look so attractive, right? From getting 5%, you can get 4% and 3%. And then people are going to feel that, hey, not too attractive. They're going to then sell or take out their money from these money market funds and put it into riskier assets like stocks, all right? So we have a lot of dry powder, a lot of cash on the sidelines that will come into the market once interest rates go down, propelling the bull market even higher. So what should you do as an investor? A common question I got yesterday would be, Adam, should I sell all my tech stocks and then buy all these non-tech stocks, the small cap stocks, the industrial and financial stocks? Well, that's not what I'm doing. As you guys know, for me, I don't bother to time these rotations because you never know when it's going to happen, number one. Number two, you never know how long it's going to last. Like, was there any way to predict yesterday's rotation? No. It's because CPI came in minus 0.1%. If CPI came in stronger than expected, then the opposite would have happened. You get your tech stocks going even higher, small caps collapsing even more. So you can't predict such stuff, right? And again, people ask me, so how long will this rotation take? Again, it may last for a few days, a few weeks, or a few months. You can't predict that because it all depends on more incoming data. So for example, the next data would be the PCE inflation data. And if that comes in hot, then the rotation may rotate back to tech stocks going up again, small caps going down again. So it's almost impossible to predict the exact short-term moves of the market. And that's why as an investor, I don't bother to. I simply stay diversified across great companies in all these different sectors. For example, currently 54% of my capital gain portfolio are in these mega cap tech stocks, the AI related stocks, like I own NVIDIA, Microsoft, Meta, Google. These are 54% of my portfolio. And 46% of my portfolio are in non-AI technology stocks. So these are, example, healthcare companies like United Health, consumer staples company like Pepsi. I own industrial companies like Pool Corporation. I own small cap ETF, VBK. So I'm diversified. So for the first part of the year, the 54% of my stocks were flying like crazy. But my 46% were kind of like not going anywhere, right? So overall, my portfolio still went up, right? Went up as of now about over 14% year to date. But yesterday, my tech stocks, the 54%, went down. But then my 46% were going up like crazy, all right? My Pepsi, my McDonald's, my pool, my real estate, REITs are all going up like crazy. And again, that pulls my portfolio up. So the important thing is to diversify your portfolio in a way that it will do well, it will continue to grow under all economic situations, whether high inflation, high interest rates, low interest rates, no matter what happens, your portfolio keeps growing. As long as you're holding the highest quality companies within these different sectors, because the rotations can take place at any moment. So I'm not selling my tech stocks. Why? Because in the long run, they will continue to grow, they'll continue to do very well. But of course, in the short term, they are a bit overextended, which I mentioned previously. So in the short term, I won't be surprised if they could go down a bit more. But I'm not going to sell it, right? Because I'm just going to ride the short term up and down. Long run, I'm just going to see it go a lot higher. So for example, in the case of NVIDIA, which is now my 5th largest position, I'm holding it, I'm not selling it, but I'm not buying more either because again, it's overextended, it is slightly overvalued right now. My intrinsic value for NVIDIA is within the range of between $94, which is the pessimistic valuation, to my more base case valuation of $122. So based on the current share price, $127, it is slightly overpriced. Will I buy more NVIDIA? Yes, I will, but only if it gets more undervalued. If it retraces, right now you can see, right? Wave up, wave down, wave up. Right now it's going a bit sideways. If it can retrace to this 20 EMA, this red dotted line, you can see that has historically been a pretty strong support at 105, below 105, and then it's nearer my pessimistic valuation. Yep, I would add more NVIDIA if it could retrace to that level. When will it happen? Will it happen? That's something I can't predict. Of course, if it flies again from here, then I won't add any more shares. That's the discipline, right? So that's what I'm doing with my tech stocks. I'm not I'm not selling, I'm holding, but I'm buying more if they retrace down to those support levels. Now, as I've mentioned many times before, while the market's been making new highs, there are a lot of high quality stocks that have been unloved that are actually attractively priced. So I've been adding to some of these in the last couple of weeks. And I will talk more about it during my upcoming live event, which is going to happen next week, towards the end of next week, called Beat the Market. So make sure you enroll for that event. But I'll just share with you some of the things that I've been adding recently. One of them is Monster Beverage. Yep, so Monster Beverage is one of the stocks that has been unloved so far this year because it's not an AI, it's not a tech stock. So if you look at a lot of the beverage stocks, like food and beverage, like McDonald's and Yum Brands and Pepsi and Monster and Celsius, they've all come down. Why? Again, it's all about short-term sentiment. It's all about sector rotation because all the love is going to AI. But eventually, these stocks will start to rebound. So I've been buying them while they are still attractively priced. So again, Monster is one that I recently added to, and one of the reasons is because I think that it is undervalued. My valuation for Monster is about $56 thereabouts, and right now it's at $50. So it is slightly undervalued, and I don't just look at valuation, of course. I look at technical analysis, and if you take a look at Monster on the longer term weekly charts, you can see that this was a previous resistance level, right? And this resistance, it broke out of that resistance, made two highs over there. Okay, and recently it has retraced back down together with a lot of food and beverage stocks, and it recently bounced off the 200-day moving average, which is a very strong long-term support, whichever time frame that you look at. So this could be a potential bottom for Monster. Again, there are no guarantees. It could, of course, go lower in the short term, but I think there's a pretty good chance that this may be the short-term bottom, at least for it to start rebounding. So Monster is one example, and again, there are many more examples I'll talk about during the Beat the Market event. So enroll for that. We'll be telling you more about that for the event coming up end of next week. Right now, some of you have been asking me a lot about Nike, for example. So Nike has been whacked recently, and not just because it's a non-AI stock, but because there have been executional problems with the management. In other words, the management really screwed up in the last couple of years, causing Nike to make all-time low. I think 52 all-time low, right? So I do have a small position in Nike. I think it's like 0.5% of my portfolio, but I'm not adding more. Okay, so long-term, do I think that Nike will recover? Yes, it's a very strong brand. It's got the strongest brand position and financial position among all its competition. But I think it's going to take a while for the recovery because they really screwed up. One of the things that the management did wrong was they cut out the wholesalers, the middleman. They sold direct to consumer, and that didn't work out. So now they're backpedaling. They've realized their mistakes. Now they're going back to sell through wholesalers and the middleman again, like Foot Locker and stuff like that. The other place they screwed up was they really took their eye off innovation. They have not been innovating very much, and they allowed some of the smaller competitors to catch up, like On Running and so on and so forth. So it will take some time for them to start to grow again, not immediate. The interesting thing is that I've got good friends working in Nike. I've got good friends working in all the Fortune 500 companies, and so even they tell me, I wouldn't add at this level until management proves that they are able to turn the ship around. And I think they will, but it'll take some time. So in the meantime, I rather allocate my money to stocks that do not have these short-term operational problems. They are merely down purely because of sentiment, because these will rebound a lot faster than Nike that will rebound, but it'll take a bit longer than that. Right? Now, there are some people voicing their concern that the last few times the Fed cut interest rates, the stock market crashed. So this time, if they cut rates, will the market crash again? Well, let's explore that, right? So yes, there were instances in the past whenever the Fed made the first rate cut, the stock market crashed. So this happened in 1981, 2001, and 2008, as I've indicated on these red arrows here. So you can see the one in kind of like this blue, call that blue. These are the first rate cuts of of a cycle, right? And these ones in so-called like gold, these are the first rate hikes. So we're looking at the blue dots over here. The first time the Fed cut rates in a cycle, right? Which is what we're going to see in September. So what can we expect after September? Now again, sure enough, when the Fed first cut rates in 2008, what happened? Market crash. When it cut rates in 21, market crash. When it cut rates in 81, market crash. So you can ask yourself this question: was it the cutting of the rate that caused the market crash? No. It's like, imagine the last 3 times, every time you took a shit, it rained. Does it mean that your shit caused the rain? No. So similarly, it is not the first rate cut that caused the crash. The crash was because of a recession, but the rate cut came in order for the Fed to stimulate the economy, hopefully to soften the recession, right? So in the case of 2008, what caused that recession? It was the bursting of the real estate bubble. And then the Fed had to cut rates in order to save that situation, right? In 2001, it was the dot-com bubble bursting that led to the recession. And again, the Fed cut rates in order to save the economy from getting worse. So as long as the Fed cuts rates without being a recession, the market will not crash. The market will keep going up. And were there many instances of this? Yes, it happened in 1980, 84, 89, 95, and 2019. These were all instances when the Fed cut rates, not because of a recession. They cut rates because they felt that rates were long enough or high long enough, and they wanted to bring it down. And so that was so-called a soft landing or a no landing. So again, 1980, they cut rates and market went up, right? 84, they cut rates, market went up. 89, they cut rates, market went up, bit of a dip, continued going up. And 95, they cut rates, market shot all the way up, okay? So if you ask me, I think that where we are today is very similar to 1995. That was the lead up to the dot-com boom, and like I keep saying, we are just at the early stages of this AI revolution. So my guess, I think we are more 1995, okay? Now, 2019 is pretty interesting. 2019, they first cut rates. Then you may say, but Adam, after they cut rates, the market crashed. Now, understand that this crash was caused by the pandemic. The pandemic was not caused by the rate cut. This was just a coincidence, right? So if not for the pandemic, you can see that after the cut, it actually went up. And if not for the pandemic, it would continue to have gone up. So as long as we don't have a severe recession coming from an unknown catalyst, fear not the first rate cut. The first rate cut is not a bearish signal as some people will suggest. So are we going to get a severe recession? Again, no one can predict that. You know what? Even the top economists can't predict when the next recession will be. Remember, they had a 100% probability of a recession in 2023 that never happened, right? So, no one can predict it. But looking at where the economy is right now, the economy is slowing, but it's still growing. And there's no severe recession in sight. Again, unless there's an unknown catalyst that no one can predict, right? So this real GDP has been growing, although again at a slowing rate. And of course, we had recently the unemployment rate ticking up to 4.1%, which is a sign that the labor market is cooling. But it's not collapsing because jobless claims and initial claims just came in lower than expected. And we had more jobs created than expected. If you take a look at the last 100 years, the stock market averages a 10% gain on average a year. And so far, in the first 6 months, it's already up 15%. So is there any gas left in the tank for the next 6 months? Well, the answer is actually based on history, yes. In fact, history shows that a strong 6 months tends to lead to a strong final 6 months as well. So this was a research done by Carson Research. And you can see that these were all the years in the past when the first 6 months of the year was strong. In other words, the first 6 months gained more than 10%. This was 1954, 55, 58, 61. These were all the years like that. And so what happened for the next 6 months? You can see that out of all those instances, 82% of those instances were positive for the next 6 months, with an average gain of 7.7% and a median gain of 9.8%. So in other words, we've got 82% chance the next 6 months we should see another 7 to 9% gain. And for the full year 2024, we should end the year positive because based on history, it has been a 100% probability that you get a positive year when the first 6 months is more than 10%, with an average gain of 25 to 26%. So if you ask me to guess, I would say we should end the year at least above 20%, and especially since this is an election year. So whichever wins, whether Republican or Democrat, election years have always, well, I wouldn't say always, right, but have an 83% probability of being a bullish year. So far everything is in favor of the bulls, unless of course again there's an unknown catalyst that no one can foresee. All right. Having said that, always remember that we are entering the second week of July, and historically, from the third week of July, right, to the end of October, you can see some huge volatility, especially the September-October period. During election years, the market tends to be a bit bearish during those 2 months before the final hurrah, the grand finale, bullish finale towards the end of the year. So let's see if that would play out for the rest of the year. In the meantime, stay safe, and remember, stick to the high quality names and you'll do really well. Remember, we'll be talking about our event coming up next week, end of next week, called Beat the Market. So look out for it and enroll, and I'll see you guys there for my live webinars. Take care. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.